Okay, ladies and gentlemen of the board of MCOM, good morning. My name is James and these are my colleagues Victor and Hugh. We're from Allez Consulting and we're here to talk about the urgent issues that MCOM is currently facing. Before we get into those issues, let's take a quick look at your current situation. Now, you've had a lot of bad news lately. The sanctions against Alanya, the fine in Alanya, and backlash against your cost-cutting measures in Sedimba. We've had to make some adjustments to your 2015 financial statements and your 2016 forecasts, and they're included in the appendices for your reference. But what this ultimately means for MCOM is that you could soon be facing insolvency and you soon may be over-leveraged. It is a concerning trajectory. So what do you have to do? Well, we're going to take you through, firstly, how to address the urgent short-term issues. We'll then take you through our recommended approach for raising capital. And finally, we'll talk to you about how you can stay ahead of your competitors. We're confident that our recommendations will effectuate a new course for MCOM, taking into account ethics and the interests of all your stakeholders. So let's get right into it. Victor?
Thank you, James. The highest priority issue to be addressed by the board is the current situation in Alanya. Currently, there is high strategic uncertainty and political risk considering that there may be long-term sanctions being placed upon MCOM from the Alanyan government. Based upon MCOM's interests and financial priorities, based on your revised risk appetite, we have analysed all your potential courses of actions. Firstly, considering that the government is likely to nationalise all private companies, there's a high chance you may lose your current stake in JV Cellular. Secondly, there have also been concerns that the JV Cellular is aiding the Alanyan government in an unethical manner. Given these two important factors, MCOM must exit Alanya now. And you can do this by selling off your stake, and there are two interested bidders. One, a Turkish mobile operator is willing to give you their equity, or two, an Indian cell phone group is willing to give you cash. Allez Consulting recommends selling to the Turkish mobile operator for three key reasons. Number one, financial payoff is much higher with the Turkish mobile operator. Number two, the cash you will receive from Platini is also dependent upon sanctions being lifted in Alanya. And number three, by undertaking the Turkish mobile operator swap, this will ensure that MCOM can continue to maintain its exposure in the Middle Eastern telecommunications market. Now, we understand that there is currently lack of information in regard to the Turkish mobile operator, and so MCOM must conduct due diligence now in order to gain the appropriate amount of information. In particular, it's important that you review the financial statements, you evaluate the liquidity and volatility of this Turkish equity, and you also assess the operating environment in Turkey. Based on that, if due diligence is successful, you should accept the offer from the Turkish mobile operator. However, if it was to fail, then you should accept Platini's offer. Ultimately though, at the end of this, MCOM will have completely exited Alanya. The next issue to be addressed is the $58 billion fine that has been levied against MCOM by the Alanya government as a result of MCOM not removing unregistered users off their phone network. And we have valued MCOM's current equity valuation between 67 and 76 billion Sedimban dollars based on a DCF model. Now, paying off the whole fine would still leave residual value in Alanya, and hence MCOM should not consider leaving Alanya just to avoid paying the fine. That being said though, paying this fine should be done if only it is absolutely necessary to continue operating, as it does wipe out 80% of the current valuation. Allez Consulting recommends that MCOM must continue to negotiate with the Alanya government now to continue to lower the size of that fine. Now, we understand that this does sound like a tough challenge. There has been much backlash from the Alanya public from the actions that MCOM have taken so far. And that's why we recommend that you offer them a solution to the underlying problem, and that is how to neutralize the Blancana terrorists. And we have three key means you can do this by. Number one, you should implement stricter than necessary know your customer or KYC processes to help convict criminals who are conducting activities on your phone network. Number two, you should assist the law enforcement officers by providing information about these unregistered users, contingent on legal advice. And number three, you should invest in a national biometric identification system in Alanya, similar to those that are currently operating in Singapore and China. By doing this, MCOM will be seen as assisting the calling government in capturing those criminals, preventing future attacks as well, and most importantly, protecting the collier's national security. In order to achieve this, MCOM must first remove all those unregistered SIM cards off their network, and then they should implement standard KYC processes, because finally, this should help establish a sense of goodwill and good faith between MCOM and the calling government, and MCOM will be well positioned to continue to negotiate a reduction in the size of that fine. The next short-term issue to be addressed is the Shared Services Centre, or the SSC, in Sedimba. Now currently, customers are threatening to boycott all of MCOM's products as a result of jobs being shifted from their domestic market to the Sedimban SSC. Now, while your investors are really happy with all those cost savings as shown here, there has been concern from your employees who are worried, and citizen rights organisations have called out MCOM for abandoning its employees altogether. We have assessed your potential courses of actions and concluded that increasing the SSC positions may actually intensify the public outcry with MCOM. This could threaten future revenues and may, if the backlash was to occur. Also, the additional cost savings are also extremely marginal. However, if you were to choose to say go back and reduce all the SSC positions down to zero, this would completely eliminate those current cost savings. Not to mention you may incur additional costs such as to transition back those jobs to their domestic market. That's why we believe that you should maintain the status quo and keep the current SSC positions. That's because you will maintain the current cost savings that you have, and the risk of a public outlash is less than if you were to increase it. In order to do this, though, you need a strategy. And so MCOM must immediately communicate this decision, not to expand the SSC, but to keep it as it is to assuage the vocal minority who are against the expansion. You must then move to reassure your current staff of their job security, because that's extremely important. And so that may help lower their discontent and also the turnover currently being experienced. And finally, you should further optimise the current SSC so you can potentially realise further cost savings in the future. Finally, in March, when you have your AGM, you should also provide a cost-saving breakdown as requested by your shareholders, and that can be found in our appendices. Hugh?
Thank you, Victor. So we've prepared a package of strategies to minimise the risk of MCOM becoming insolvent. However, over the next 12 months, MCOM will still be in a precarious situation. If there are consumer boycotts and the Nicolian government demands full payment of the $58 billion fine, MCOM will be insolvent. To prevent insolvency, MCOM needs to raise $30 billion of capital now. We recommend raising $10 billion of equity through an accelerated book build and $20 billion of debt through an unsecured line of credit. This will ensure that MCOM stays solvent until the end of this year. That is when MCOM should shift its focus from these short-term issues to focusing on maintaining its #1 position in the African telco market. We have analysed a number of current macroeconomic trends and have formulated a growth strategy to help MCOM stay ahead. Let's take a look. Firstly, we recommend that MCOM pursue an asset-light operating model by spinning off its fixed assets into a new entity. Secondly, we recommend that MCOM continue to adjust its products to match the changing demands of its consumers. Finally, we recommend that MCOM continue to focus on its core market, Africa, while evaluating emerging opportunities in Asia. First, the asset spin-off. MCOM and its investors are currently exposed to sovereign risk, government fines, and equity market volatility. This is driving a high cost of capital. MCOM can unlock significant shareholder value by spinning off its fixed assets into a new entity, AssetCo. AssetCo will only be composed of stable fixed assets, driving a much lower cost of capital. Ultimately, this will make MCOM leaner and more agile, helping it adapt rapidly to changing consumer demands. Now, this is a very exciting time to be in the telecommunications sector. Around every 8 years, a new generation of transmission technology emerges, from 2G to 3G and from 3G to 4G. As new technologies emerge, the game of maintaining existing and winning new market share has always been about increasing coverage, increasing bandwidth, and increasing data speeds. This is driven by a constant cycle of building and upgrading infrastructure. This is, however, very capital intensive. AssetCo can raise capital at a much lower cost compared to MCOM. This can be seen in this historical chart, where tower operators, like our proposed ASICO, have traded at much higher multiples compared to telecom companies like MCOM. Hence, ASICO should make this investment in new infrastructure and lease back this infrastructure to MCOM. Ultimately, this transaction will increase MCOM's earnings per share. Finally, we turn to the question of where MCOM should focus its growth geographically. We found that growth will be the highest in sub-Saharan Africa and the Asia-Pacific region. Furthermore, the high population in these two continents are currently being underserved by existing telcos. Hence, MCOM should continue to focus on its core market, Africa, while evaluating emerging opportunities in the Asia-Pacific region. James?
Thanks, Hugh. One of these emerging opportunities in the Asia-Pacific is to invest in Chinesia. We assessed the strategy of entering Chinesia as a wholly foreign-owned subsidiary, and our analysis found that an MCOM subsidiary would face significant barriers to entry, whereas the market incumbents such as CloudNet and C-Mobile are already several steps ahead. MCOM does not know this Chinesian market. They've never before entered a non-African market without the help of a local joint venture partner. Cost synergies are negligible, and in any case, we know that there's a higher chance that local bidders will be treated favourably in the granting of operating licences. So we don't think that organic market entry is a good idea. This option should be ruled out. Now, come 2018, the licences of the top 4 players in the market will expire. And there's an 85% chance, based on historical data, that at least one of these 4 licenses will not be renewed. Millions of subscribers will be looking to switch to a new carrier, and this is C-Mobile's opportunity to acquire customers from the premium segment. But those customers are premium customers, and C-Mobile currently services the budget end of the market. In order to service the very big and very lucrative premium segment, they're going to have to reposition themselves. And they can't do that alone. This is where MCOM comes into the picture. C-Mobile needs to invest in marketing and lease 3G towers. Both of those require capital. MCOM can make the capital investment that C-Mobile needs. So, the preferred approach for entering Chinesia. Approach C-Mobile with an offer of equity funding to support their growth. C-Mobile wins, MCOM wins. It is a win-win strategy. As per your brief, we also considered the option of buying into CloudNet. Unlike with C-Mobile, you already have an offer on the table. Although the offer price is at a discount to intrinsic value, there are no supporting financials. So this is a risky investment. You do need to allow time to conduct due diligence into CloudNet. So what do you need to do? You want to enter Chinesia working either with C-Mobile or CloudNet. Indicate your interest to both companies early on. And later, you can start working through the details, including compliance with license conditions with either C-Mobile or CloudNet. So, let's recap. Today, MCOM is on a dangerous course towards potential insolvency. We've presented 4 strategies that will help get MCOM back on track. Firstly, raise debt and equity capital. Secondly, exit Alanya and start by conducting due diligence into the Turkish mobile operator. Thirdly, in relation to the Napoleon fine, use your position to assist the government in dealing with the underlying security crisis. And fourthly, in Sedimba, keep the shared services centre at the size that it is today. Once MCOM is back on track, then you can focus on maintaining your leading position in the telecommunications sector. We now invite questions from the board.
Thank you, Allez Consulting. A very concise and well communicated proposal. Thank you very much for that. I just have 2 questions, one generic and more strategic related, and 2 slightly technical. So I can share with you both of them, and then you can think about which to answer first. Essentially, in terms of timing, I'm a little bit lost on. You're proposing a lot here, and it seems like it solves world peace for us, at least, okay? Which is great, so you have the answers here. I'm finding it as a board very overwhelming to be in the position that we are in anyway at the moment. So what you are proposing is a number of big ticket items in a number of multiple geographies, which adds complexity and uncertainty, of course. Okay, so in terms of risk management, what do you feel is the critical success factors to enabling this execution of your recommendations, and what would be the pitfalls? So what not to do? Because all we can see right now is that fine looming. You know, our market cap declining, our share price declining, our credit risk going up. So, you know, we're just already nervous about talking to banks anyway. So, or you know, forget starting up another entity in another country that we actually don't operate in. So, just your comments on that strategically, please. And then the other one, which is you know, a minor point on the asset co. It looks great on paper. It sounds to me a little bit like we're shifting the problem and then charging out back to the interco. What are the transfer pricing considerations here? Because I know there's some IFRS in this world around transfer pricing, and all we're doing is moving the problem out and then charging back anyway, back to the group. It just sounds like, from a governance perspective, you know, we don't want to do anything dodge.
So in terms of spinning off fixed assets into a new entity, that's something that's already been quite precedented in the telecommunications sector. And so what we're really proposing isn't some sort of shifting of items between new entities that are being created underneath MCOM. What we're proposing is a new entity, and that new entity can raise new capital, invest in new infrastructure to lease back to telcos like MCOM. Furthermore, given that infrastructure is quite expensive, one of the other things that existing players do in this market is to lease back this infrastructure to other telco players in the market, ultimately increasing the return on that capital invested. From a transfer pricing perspective, generally it's arm's length transactions. And given that there's a lot of precedent of those particular transactions already in the marketplace, that should be something that should be quite achievable to be compliant with legislation.
If that answers the second question, maybe I'll speak to the first. So these are some very big recommendations that we've proposed. And the reason that we've put them all on the table, and it is quite overwhelming, there's a lot to do, is because of the seriousness of the current situation. There are lots of different things that are going on around the world, in different subsidiaries, in different markets, in different geographies. And what we've presented is an integrated package of solutions. We think they all need to be addressed at some point. We've prioritised the ones that are most urgent at this point, namely the Alanya joint venture. It's very important that that issue is dealt with. The fine, obviously, very, very important at this point in time. And also the shared services centre. And what underlies all three of those major urgent issues is that they also affect your public image. So when you can put together an integrated package of solutions that address all three of those, it does give the confidence back to the public and also to your investors. Once those issues are dealt with, other things become easier, such as raising capital, approaching banks, and raising equity capital. So the reason that we've put it through the timeline that we've given for our solutions is to start putting all of these problems on the table, start talking about them and get them sorted. And it does align with your new risk profile and risk appetite, and the details of those are included in the appendices.
All right, thank you very much. You've made suggestions in terms of suggested capital structure. Will you share with the board briefly what are the underlying philosophy that inform the choice of that capital structure? Secondly, given that change, it's something that at operational level, might be difficult to implement. What strategy will you ensure to take the people of the organization along in implementing the suggested strategy? Thank you.
Thank you. So perhaps Yep, another question.
I just want to add to Prof's question around the capital. You recommend a third to be raised on from equity. So I'm assuming you are recommending that they should list on the Nigerian Stock Exchange, as the government wants. And you also say 2/3 should be raised through an unsecured line of credit. Am I right to also think that that should also be in Nakolia, or is it in Zanzibar? And whichever place it will be, why unsecured, and what makes you confident that we will be able to get a huge line of credit as such to be unsecured?
Okay.
Thank
So
you.
the first part and the second part.
So that's a very important question in terms of the capital structure of the company. So I'll just go back to the slide where we discussed this. So firstly, raising equity capital is quite important, because if you raise all of it through debt, then the company will become quite over-leveraged. And so when we're talking about raising equity, our recommendation is to raise it through MCOM and not to list on the Nigerian Stock Exchange. The reason why we're suggesting an accelerated book build is because currently MCOM is experiencing a lot of volatility on the capital markets. And so the accelerated book build is done over a single night, so it reduces the risk of further diluting the shareholders and shareholders selling up their stock. So that's why we're recommending the accelerated book build. In terms of unsecured line of credit, there are a few options here. You can raise either secured debt or unsecured debt. The problem is that MCOM is currently reaching its limit of having secured debt. There just is not enough fixed assets to raise all of that capital. And so that's why the debt has to be unsecured. Given that unsecured debt usually is a bit of a higher cost than secured debt, but that's something that we can't really do because there's just not enough fixed assets. So there are a couple of things that, in terms of raising this capital, we think that raising around 15 to 19% is a possible interest rate. In terms of, it's still quite high given this 15 to 90% interest rate. And so the other part of the strategy that we're recommending is really spinning off your fixed assets into a new entity, ASICO. And ASICO can borrow at a much lower rate. Based on current yields are around 4 to 5% in the market, and that's really going to lower the cost of capital for MCOM. Does that answer your question?
Thank you. And going back to the operational comment as well, and going back to our key recommendations, I think what we're really trying to understand is that this is about your clients, which are your mobile operators and the people that you do business with. And like we've mentioned, and a bit about the risk management processes as well, it all starts making sure that your customers are happy. And so all the measures that we've implemented now are to address the issues of, say, compliance, that negative perception as well. Operationally, it's extremely important that your staff are on board. And that's one of the key reasons why we think Sedimba can actually be a real benefit to your company, because if you train your staff properly, and ultimately it's about service in the telecommunications industry, your customers want a great service, they want to make sure that they're part of a great company as well. And so if you train your staff and give them that benefit, and by having all this additional capital, this can ultimately help your business grow and invest, not only in, say, the infrastructure, which we're suggesting, but also in the staff and that whole training process as well. And so that's how we want to manage it operationally.
Just a question. I'm surprised that you would motivate to look at C-Mobile. Just your thinking around that. Because in the mobile environment, the most critical thing is brand. And to take brand, it takes years to build brand on the one side. And to move from low ARPUs to higher margin ARPUs is quite difficult. Just share your thinking, your strategic thinking around it.
I'll start off. So I think first and foremost, we understand that MCOM has a great brand in Africa, but before all these situations have started to occur, but still they are obviously the market leader. And so by leveraging off your current reputation, when you say would acquire C-Mobile as well, you can leverage off a combined brand and invest in that brand as well. So you can use what you know in Africa and take it to other countries when you are investing into C-Mobile. I think it's important as well when you do enter a new market that you make sure that you have the right infrastructure and capital in place so that bad publicity doesn't occur, because if a customer does choose to stay with C-Mobile, it is very easy for them to go to something more trusted as well. So I think it's important that you lay those foundations down when you first go into a new market. And as we suggested, that C-Mobile currently has the license and they're not going to expire that license as well. So that growth, if it's managed well, potentially take market from the leading 4 telecommunication companies and bring it over to C-Mobile with the help of MCOM.